Thursday, after the Federal Reserve announced a new multi-trillion-dollar stimulus plan to support businesses during the coronavirus pandemic, stocks rallied to their best weekly gain in more than 4 decades. For the S&P 500, that was a weekly gain of 12.1%. News of the coronavirus has been more positive, with growth in new cases having slowed or even turned negative in global epicenters. Apart from signs of potential easing in new coronavirus cases, further stimulus to support the economy has also helped the stock market. The Federal Reserve unveiled a plan for another $2.3 trillion for households and local governments. Additionally, Congress has been pushing to deliver an additional $250 billion of small business aid to go along with the $2.2 trillion pandemic relief package that has already been passed. However, we'll have to wait a bit longer while Congress bickers about the details. But with the recent stellar performance of the stock market, is the great coronavirus bear market of 2020 now history? Well, let's take a look. Now that we're 20% higher than the mid-March low, bulls will say that the bear market is over and we're in a new bull market. But that avoids the obvious question of whether we retest the lows. According to Mark Hobart, we're going to test the low. His study of past bear markets points to the March low being tested or even broken. His evidence? Since the Dow Jones Industrial Average was created, there have been 38 other occasions where the Dow rallied just as much or more in just as short a period, and all of them occurred during the Great Depression. According to Ned Davis, there have been 11 bear markets where the Dow fell by more than 37.1%, which is about how much the Dow has fallen here in 2020. On average, the final bear market low came 137 days after first registering such a loss. If the average holds, then the projected low on the Dow will be August 7th. Holbert also points to market sentiment. Typically, a bear market bottom is marked by pessimism and despair, but that's not what we've seen over the last couple of weeks. Another indication pointed to by Hobart is the VIX, the volatility index, also known as the fear factor. An analysis of all bear markets since 1990 shows that VIX almost always hits its high well before the bear market registers its final low. The only two exceptions came after the 9/11 terrorist attacks and at the end of the 2-month bear market in 1998. In those two cases, the VIX's high came on the same day of the bear market's low. Other than these two exceptions, the average lead time of the VIX's peak to the bear market low was 90 days, or June 14th. Apparently, Hobart is expecting more volatility until June 14th, or perhaps as long as until August 7th. We'll see. But let's not forget to give equal time to an opposing opinion. And so here it is. According to Tom Lee of Fundstrat Global Advisors, stocks could be setting up for an even more fierce recovery than we've already experienced. Specific to Lee's thesis is the historical performance of markets during prior 30% declines. Looking at the last 10 such occurrences over the past 2 centuries, Lee points out striking uniformity between the time to recover losses and how quickly stocks moved from top to bottom. Using the average ratio of collapse to recovery times during prior bear markets, Lee hypothesized back on March 24th, or about 2 weeks ago, just after the market losses totaled about 33%, that the S&P 500 could recover 50% of those losses in just 3 weeks. On Thursday, or yesterday, the S&P 500 briefly did just that. According to Lee, the speed that you fall tells you how quickly you recovered half your losses and actually how long it takes to recover your full losses. Lee went on to say that based on his model, we should be making all-time highs in 3 times the amount of time it took to fall, which means if we fell over 6 weeks, sometime in July, August, or September, we may be back to all-time highs. If you remember, Mark Hobart says that we should be back to the lows in about the same time period. So how's that for opposing opinions? Lee has drawn the 50% retracement line in the sand as the mark that has historically confirmed an all clear signal for investors. During this route, that level in the S&P 500 is 2793. The fact that it recovered to 2793, it's a big deal, he said. If you look back at 1987, 2002, or even '08 or '09, when the stock market recovered half its losses, it was already deep into a bull market recovery. I think the move today is pretty decisive. Looking at the historical average ratio of time to travel from peak to trough to recovery, Tom Lee points out that the last 10 drawdowns indicate the time to fully recover is 2.5 times the amount of time to collapse. That would indicate 100% recovery from March lows in 3 to 4 months. In Saturday's stock market update, we'll take a closer look at our charts and see what they say. But for today, that's ChewDog Charts. Thank you.